Okay, so you want to own a pawn shop, money lent, items held, a queue of people who need cash today. And you'd assume, like any lender, that your nightmare is the customer who doesn't pay you back. Here's what makes this business genuinely unlike any other lender on earth. You do not have that nightmare. You cannot have a bad loan. Because before you handed over a single note, the thing you're lending against was already in your hands and you lent far less than it is worth. So if they pay, you make money. And if they don't pay, you also make money. Default is not a risk in this business. It is just the other way you get paid. So let's take that apart, because it is a genuinely strange structure. And once you understand it, you will understand why this business has existed, more or less unchanged. But before the structure briefly, what it takes to open one, because it is not what people expect. The largest thing you need is not a shop, it is cash. Think about what your working capital actually is in this business. Every loan you make is money leaving your till and not coming back for weeks, and every item you buy outright is money converted into an object sitting on a shelf. So the busier you are, the more of your own money is tied up in other people's rings, which means a pawn shop is in a very real sense a pile of cash that happens to have a shop wrapped around it. Run out of cash and you cannot lend. And if you cannot lend, you are not a pawnbroker. You are a second-hand shop with a queue outside it that you have to turn away. And then the security. Because you are, by definition, a building containing a large quantity of gold, jewelry, and cash in a location that everybody in town knows about. So you need a serious safe, alarms, cameras, reinforced glass, and controlled access to the back. That is a real capital cost, and it is not optional. And then the license. Because this is a regulated activity in most places, and always has been. And you will need permission to operate, and you will be subject to inspection, and the terms of the loans you offer are frequently set by law rather than by you, which is worth pausing on. In most industries, the price is yours to set. Here, the interest and the fees are often capped by statute. So the single lever most businesses reach for first is simply not available to you. All right, now the structure. Start with the sequence of events, because the order is everything. In almost every other kind of lending, the money goes out first, and the security comes later, or never. A bank lends you money to buy a house, and it takes a charge over that house. But the house is not in the bank's building. It is on a street, with you living in it. If it all goes wrong, the bank has to go and get it, which is slow, expensive, and unpleasant. A pawn shop does not do that. Somebody walks in with an object, a gold chain, a guitar, a ring, and you look at it, and you price it, and you make an offer. And if they accept, the item goes into your drawer, and the money goes into their hand. The collateral is in your possession before the loan exists. Now sit with what that does. It means you do not have to think about the person at all. You do not need a credit check, because their credit history is irrelevant. You do not need proof of income, because their income is irrelevant. You do not need to ask what the money is for, and you do not want to know. And in most cases, you never will. You are not making a judgment about a human being's reliability. You are making a judgment about an object. That is the entire pivot of this business. Every other lender is in the business of predicting human behavior. A pawnbroker is in the business of pricing a chainsaw. And it is why the pawnbroker can lend to people that nobody else on earth will lend to, not out of generosity, out of indifference. The pawnbroker genuinely does not care whether you are a good credit risk, because you are not the security. The ring is. Now, let's look at the number that makes the whole thing safe, and it is also the number that makes people angry, and both of those things are true at the same time. The loan-to-value ratio. Somebody brings in an item, and you form a view about what it would fetch if you had to sell it. And then you lend them a fraction of that, not all of it, not most of it. A fraction, perhaps a quarter of what it is worth, perhaps half. If it is gold and the price is easy to check, that gap between what the thing is worth and what you handed over is your entire margin of safety. Because if they never come back, you sell the item and you recover what you lent and more. You cannot lose. The gap is the reason. And now let me put the other side of that sentence immediately, because it would be dishonest not to. That same gap is why a person walks out of a pawn shop with £100, having handed over something worth 400, feeling like they have been done over. And they are not wrong to feel that. They handed you something valuable and got a fraction of it. Both of those things are true. The gap is what allows you to lend to somebody with no credit, no income proof, no questions, and no consequences beyond the item itself. And the gap is also, from the other side of that counter, the reason this business has never been loved. I am not going to resolve that for you. It is not resolvable. It is simply what the business is. And anybody who tells you it is a straightforwardly good thing or a straightforwardly bad thing is not paying attention. All right, now the loan itself. A pawn loan is short, typically a matter of weeks or months, depending on where you are and what the law allows. And it carries interest and fees, and those are set by regulation in most places. Because this is a regulated activity and always has been, and at the end of the term, one of two things happens. The first is that the customer comes back. They pay what they owe, plus the interest and the fees, and you hand back the ring, and this happens far more often than people assume. The overwhelming majority of pawn customers redeem their items. They are not walking in to sell. They are walking in to borrow, and the thing they left with you matters to them, often enormously, and they fully intend to come back for it, and they do. And that changes the character of the business in a way that surprises people who have only seen it from outside. Because if most customers come back, then most customers are not strangers. They are regulars, the same person with the same item in a rhythm that both sides understand completely. In at the start of the month, out when the wages land. Some shops have customers who have pawned and redeemed the same chain dozens of times over years, and both parties treat it as entirely routine, because it is. That relationship is real, and it is not adversarial. The pawnbroker who is cruel or dismissive, or who makes people feel small, loses those customers to the shop down the road, because in a town with more than one pawnbroker, the person deciding where to take their grandmother's ring is choosing between people, not just prices. So the counter is not the cold transactional place. It is usually depicted as, in a well-run shop, it looks a lot more like a bank branch from 50 years ago, where the person behind the glass knows your name. The second thing that can happen is that they don't come back, and the item is forfeited, and it becomes yours, and you sell it. Now here is the structural thing that makes this business so unusual, and I want to be very precise about it. You are indifferent between those two outcomes. If they redeem, you earned interest and fees, and you did it without risking a penny, because the collateral was in your possession the entire time. If they forfeit, you now own an item you lent a fraction of the value of, and you can sell it for more than you lent. Both outcomes pay you. There is no version of the transaction where you lose unless you got the valuation wrong. Which means, and this is the uncomfortable sentence at the heart of this episode, the customer's failure is not your loss. That is genuinely rare. In almost every other business, when the customer fails, you suffer. When a bank's borrower stops paying, that is a catastrophe. When a tenant stops paying rent, that is a hole in your income. The whole of commercial life is built on the idea that you need your customer to succeed. Here, you don't. You just need the ring to be real. Now, all of that safety rests on one thing, and if you get it wrong, none of it works. So let's talk about the actual skill in this business, because it is not lending and it is not selling. It is appraisal. Somebody puts a gold chain on the counter, and you have to answer in about 90 seconds, with them standing there waiting, a very specific question. And it is not, what is this worth? It is, what will this fetch in this town, this month, if I have to sell it and I cannot wait for the perfect buyer? That is a completely different number from the retail price. It is a forced sale number in a specific local market with a specific time frame. And it is the only number that matters because it is the number you will actually receive if this loan is not redeemed. And you have to be able to do that for gold, which is relatively easy because it has a spot price and you can test its purity. And for diamonds, which is far harder because the value depends on cut and clarity and color and certification, and the customer is holding a ring their grandmother left them and is quite certain it is priceless. And for a guitar, where the difference between a common model and a rare one is enormous and is not visible from across a counter, and for tools, and for watches, and for game consoles. Get that number right consistently, and you have a business that genuinely cannot lose. Get it wrong, and the entire protection collapses. Because if you lend 200 against something that will only fetch 120, you have just done the one thing a pawnbroker is not supposed to be able to do. You have made a bad loan, and it was not the customer's fault. It was yours. Which is why the good ones say something that sounds strange at first, and is completely correct. You cannot have a bad customer in this business. You can only have a bad valuation. And there is a difficulty inside that which nobody warns you about, and it is the hardest part of the job by a distance. You have to say the number out loud to the person's face, because the customer standing in front of you does not have your valuation. They have their own, and theirs is almost always higher, and it is higher for reasons that are completely human. they paid a certain amount for it, or somebody they loved gave it to them. Or the internet told them a similar one sold for a lot of money, which it may well have done, to a collector after 6 months of waiting. And you have to look at that person and offer them considerably less than they hoped, and hold the number and do it kindly. The pawnbroker, who cannot hold the number, who softens it because the person seems desperate or because the conversation is uncomfortable, does not become a nicer pawnbroker. He becomes a bankrupt one, slowly, one generous mistake at a time. That is the actual job, not the lending, the saying of an unwelcome true number to somebody who is hoping for a different one. So where does the money come from? Let's stack it. The first layer is the interest and fees on loans that get redeemed. And in many shops, this is the core, and it is steady. And it comes from customers who come back month after month, sometimes with the same item, in a rhythm that both sides understand perfectly. The second layer is retail, selling the forfeited items. And this is bigger than people expect. In a great many pawn shops, a very large share of the profit is not interest at all. It is the margin on selling secondhand goods that came into your possession at a fraction of their value, which means the honest description of this business is that it is two businesses standing in the same room. It is a lender, and it is a secondhand shop, and those require completely different skills. One is about pricing risk in 90 seconds. The other is about display and pricing, and knowing which guitar will sit on your wall for a year and which one will go this weekend. And a pawnbroker who is brilliant at the first and hopeless at the second will end up with a shop full of accurately valued objects that nobody is buying. The third layer is straightforward buying. Somebody comes in and does not want a loan at all. They want to sell. So you buy the item outright at a price and you sell it at a higher one. No loan, no interest, no waiting. Pure retail. And the fourth, and it is the quiet, enormous one in a great many shops, is gold. Because a significant share of what comes across a pawn counter is precious metal, and gold has a peculiar property. It has a floor value that has nothing to do with what the object is. A gold chain that nobody wants to buy, in an unfashionable style, scratched, is still gold. And gold can be melted, which means there is a price beneath which the object cannot fall, because it can always be scrapped for the metal. And that is a genuinely powerful thing to have underneath your inventory. It means that for a large part of your stock, you have a guaranteed buyer of last resort, which is the metal market itself. The object may be worthless. The gold never is. So the pawnbroker is, quietly, partly in the commodities business, and does not always describe himself that way. Which brings us neatly to the first trapdoor. Because if you are partly in the gold business, then you are exposed to the price of gold, and you do not control it in any way whatsoever. Watch what happens if the gold price falls sharply. Every loan you have written in the last few months was sized against a valuation that assumed a higher metal price, which means, suddenly, a portion of your loan book is under-collateralized. The thing in your drawer is now worth less than you thought, and possibly less than you lent. You have done nothing wrong. You valued correctly at the time, and the ground moved underneath you because a commodity market on the other side of the world moved, and now your safety margin has thinned or vanished. So the pawnbroker who thinks he is running a lending business and does not watch the metal price is missing half of his own risk. And now, the second trapdoor, and it is the serious one. You are a magnet for stolen property. I want to state that carefully because it is not an accusation about the industry. It is a structural fact about what a pawn shop is. You are a place that converts objects into cash, quickly, with minimal questions. And that is exactly what a thief needs. So this business operates under a permanent, unavoidable, and entirely justified level of scrutiny. In most jurisdictions, you are legally required to record every transaction, to take identification, to report what you have taken in, often to the police, often daily, to hold items for a defined period before they can be sold, so that stolen goods can be identified and recovered. And police will, routinely, come and look at your stock against lists of what has been reported stolen. And here is your exposure, and it is genuinely painful. If it turns out that the item you took in was stolen, you do not get to keep it. It goes back to its rightful owner as it should, and the money you handed over is gone because the person who gave you the item is not coming back to repay you. And if they are found, they very likely have nothing. So you lose the item, and you lose the money, and you did nothing wrong except fail to detect a lie told to you across a counter, which is why the good shops are so careful and so bureaucratic and so meticulous about identification. Not because they enjoy paperwork, because the alternative is being robbed twice, once by the thief and once by the law, and quite rightly so. All right, now let's talk about the part of this business that people argue about because we should, and because ducking it would be cowardly. Who is the customer? The pawn customer is overwhelmingly somebody who cannot borrow anywhere else. They do not have a credit card with room on it. They do not have an overdraft. A bank will not lend them £200 and would not consider it worth the paperwork if it would. And they need money now, this week, for a bill or a repair or a rent shortfall or an emergency. And the criticism of this industry is real, and it deserves to be stated at full strength rather than waved away. It is that when you express the cost of a short pawn loan as an annual percentage rate, the number is enormous. It looks extortionate because by the standards of a mortgage or a credit card, it is. And that these are people who can least afford it, paying the most for it. And that a business which profits either way is profiting from a person's worst week. That is a serious argument, and I am not going to pretend it isn't. Here is the other side stated with equal seriousness. An annual percentage rate is a strange way to describe a 30-day loan of £80. The absolute cost, in pounds, is small, because the loan is small, and it is short, and the comparison is not with a credit card, because that person cannot get a credit card. The honest comparison is with what actually happens if the money doesn't arrive. And there's one more thing, and it matters more than people realize. If a pawn customer cannot repay, what happens to them? Nothing. There is no collections process, no debt collector, no court, no damage to their credit file, because there was no credit check to begin with. Nobody phones them. The loan simply ends, and the item is gone. And that is the whole of the consequence. Compare that to what happens when somebody defaults on almost any other kind of debt, and the difference is enormous. A pawn loan is the only form of borrowing where failing to repay costs you the item and nothing else. Your life is not pursued, so which is it? Predatory or the last honest door in a wall of closed ones? I think the truthful answer is that it is both at once, and that the tension does not resolve, and that anybody who is certain about it is not looking properly. It is a business that helps people who have nowhere else to go, and it makes money whether or not their situation improves, and both halves of that sentence are permanently true. So let's answer the question we started with. What do you actually own when you own a pawn shop? You own the only lending business on earth that does not need to be repaid. You own a drawer, and the drawer is your loan book, and the loan book is made of objects rather than promises. You own a second-hand shop that you did not choose the stock for. You own an exposure to the gold price that you may not have noticed you had. And you own a permanent, unavoidable relationship with the police. Because of what you are, not because of anything you did. And behind the counter, in that drawer, is a row of wedding rings and watches and instruments. And every single one of them belonged to somebody who meant to come back for it. So, should you buy one? Here is the honest split. The optimistic version goes like this. You are genuinely unusually good at valuation, which is the only skill that actually matters, and you are honest about what you do not know, and you decline the diamond you cannot price rather than guessing. You keep your loan-to-value conservative so that the gold price can move against you, and you are still covered. You run a clean, meticulous, well-documented shop so that the police regard you as an ally rather than a suspect. You are as good at retail as you are at lending, so the forfeited stock actually sells. And you provide a service that a great many people genuinely need at a price that is regulated, with a consequence for failure that is gentler than anything else available to them. The harder version looks like this. You were confident about a valuation you should not have been confident about several times, and the drawer filled with things worth less than you lent against them. The metal price moved and thinned your cushion on everything you wrote last quarter. Somebody handed you a stolen watch with a very good story attached, and you lost the watch and the money and had a conversation you never want to have again. And your shop window is full of accurately priced guitars that nobody in your town wants to buy. And notice what decides between those two futures. It is never the customer. It was never going to be the customer. Because in the end, a pawn shop does not lend money to people. It lends money to objects. And the only question it ever really asks is not whether you will come back. It is what you left behind and what it will fetch when you don't.